abscess in my tooth. Let me know America. Interest rates, why is which is a dramatic for ages of people. Also the rest of it, when Jerome's up there, it's immediately starting to think, oh no. I know if there's, well, okay, that's weird. Maybe that. I mean, it wasn't up. Maybe say there are reasons why this could be dropping. Doesn't look good though. Back, but we've been extremely months rooted. So it's news really rooted. So it's news really well. We've got great surprise. Bands in the background there are real. The Bitcoin, and I think it does any movement below here. Coins are the main story, and as we could, things were wasn't obvious that we're only and price of altcoins continue a high followed by another high, on the chart. But the question here is can the tail wag the dog, and can it be altcoins that help push Bitcoin up? But if Bitcoin avoid the risk that would be associated with a higher move, a bigger percentage move, bigger percentage move down, probably, if Bitcoin and alts move first and drag alt, and we spoke about this a lot, it's at 240. One of the other ones went at, and it's had a bit of a pullback. So I'm keeping an eye out, looking around, at all the different things. You can take a look at meme coins, like meme. Let's take a look at meme USDT. It's not one of the better meme coins. It worked out well for altcoin, jump up a lot. And you got the things like Cardano, build the high from. They actually did put in a higher high in July, which is one of the more unusual ones, but you can start to see by the picture evolving here of me looking at the altcoins and saying they might be the tail that wags the dog, and you get signs of that, as you see, like with this high up here, so positive. And I'm looking to see if that can carry the market. There is, if you've got weakness in the labour market, it's because the economy is doing so badly, everyone's losing their jobs, and you don't have to worry too much about inflation because it's being taken care of by the fact that nobody's getting jobs. We're experiencing inflation right now, so it's a double-edged sword. And this is this is the chat that Jerome was having during his speech today. I'm seeing everybody saying the lag is real in the chat there. Audio visual jumping around. Oh, that's cool then. Well, everybody, hope you have a great time. Catches all. It's working for me. The internet's upload speed's 250 megabytes. I mean, I can't. What can you do, right? So like I said, Trump has got tariffs in, but they're not actually a big deal right now. In terms of effective inflation, but inflation is real, and now what's coming down the line will be a bump on all of those costs, because the businesses are going to start passing the costs onto the consumer. So there will be inflation because of tariffs, but it hasn't happened quite yet. So there's uncertainty, which is a risk, which creates inflation in and of itself. When there's uncertainty, there's inflation risks. All of these inflation risks to do with as mortgage applications grew nearly 30% before Fed rate decision. That's a lot of growth in mortgage rates. What do people get when they get mortgages? Money. What do they do when they've got money? They spend it. So that's a part of inflation, and you can see it right there. The people are thinking, hey, if interest rates are going to start dropping, I'm going to get a mortgage now. Maybe I'll get an even better deal on a mortgage than I was going to get a week ago. It's great. I'm going to now buy a new car as well, a mortgage and a car. Inflation, and this is all to do with the expectations. Managing the economy is a job of managing expectations, and the expectations problems. Like there's a heck of a lot less immigrants looking to get jobs in the United States currently, so a lot less, and as a result there's a lot less people actually entering the job market, a lot less new jobs being created. But the big scary kind of number isn't so much about the new jobs being created, but actually about the people looking to get jobs. In July it was 150,000, and this month it's dropped a heck of a lot. Now if that continues, then that spells for bad news, a weak labour market, yet you have these incoming inflation risks. So it's a dual-sided sword, and that's why we're seeing a massive range in the Fed. Cycles round, different ones vote at different times, As Jerome Powell said today, the only way that you can convince other people or get people, or the only way that you can swing a vote one way or another as an individual is to be really great at convincing other people. And what they use is data and their own understanding of the economy. Europeans, same, they cut them before America. Canada, the same, they cut before America. So is it that the people in the room have got different opinions and it's a little bit chaotic and they just had different opinions and different data? No. It's that America's got a unique situation right now. And I think this Rorschach picture here of the BBC homepage does a really good job of displaying that for you. Like, where are your eyes drawn to most on this page? Is it the bottom left bit there where we have the news about the Fed lowering the US interest rates? Clearly where my eyes get drawn to. Is it on the top right though, where you have the King of America meeting the King of Britain today? And that story there does an awful lot to highlight, a lot of where this uncertainty is coming from, because of course the King of America was, what was it, King Edward, like 300 years ago, and then you got rid of him with your independence war. Well done, you've won it very, very well. And now we're back in a situation where we seem to have another King of America, and this time it's Donald Trump. But he's been doing different things, like this meeting here, playing a lot of golf in Scotland, and putting tariffs in place and so on. And all this uncertainty is what is causing the issue. So this is the Rorschach picture. Like, where is your eye most attracted to on this page? Will kind of maybe give you a bit of insight as to what type of investor you are. The bottom left is obviously where you should be looking, and here's the headlines, right? So Federal Reserve Jerome Powell has told the world that the group of them together, who need to vote together to make the decision, because it's not just him on his own, that most people don't realize, and maybe even some presidents don't know. Anyway, the 12 of them together, and the group of 19 that there are, have moved to reduce interest rates. So you could say that they do know that it's a group that votes, and you could say that they've been pushing other people at the job and put new ones in to create this space. But at the same time, the evidence kind of shows, with just a 25% basis point cut in September, that the Fed remains really strongly independent and operating just on the data that it's got. And here's where the costs, except the data and the decisions that they make are actually looking in the rear view mirror, right? Now, there's a phrase in America about look out the windscreen and don't look in the rear view mirror. It's kind of about living in the present and not living in the past and stuff like that. Except when it comes to the data at the Fed, it's actually the opposite. And the way that they work is they look at the rear view mirror and they operate on hard data. So the fact that we all know that currently the effect of tariffs on inflation is 0.3 of 2.9. So if without tariffs, inflation would still be at 2.6, which would be quite low. Okay, overall, not near target quite yet, but that's low compared to the past. The effect isn't that big. So we all know that it's coming down the line because the businesses can't absorb that and will pass it on to consumers eventually, and that will be inflation. But you can't predict that, because that means that the Fed is becoming political, and politics, governments make decisions where they try to predict how things will go and then put policy in place looking forward and planning for the future, because that's what they want, and basing decisions on their theories about how society will work. And then but the Federal Reserve's job is strictly to look at the back window at the data and make hard decisions about how to run the economy. And that's where the conflict exists. So they're waiting for data to come in before they can make any decision. And we finally got data that is hard enough to say, look, we can make a cut. But they couldn't in July, even though we all knew that we'd be here now, which is kind of the bizarre situation. But if you were to start acting like that, it would be worse, right? So the Fed doesn't. So it's always worse if the Fed starts trying to preempt what's going to happen in the world. It's way better if they are consistent in their approach. And this is decided decades and decades ago that this is the case after decades of volatility in global markets. So it's like, this isn't new, and it's been well tried and tested. And the balance of risks has shifted towards the employment side of the Fed's mandate, where the risks has previously been tilted towards inflation, and that's given them the route in to say that we can make a cut without having to, lose any face. Trump gets to keep face, lots of face today. In fact, his face and King Charles's face are featuring in photos beside each other, so there's plenty of face for the president. And then Jerome Powell, with his kind of data-driven approach and having real data, there's plenty of face saving for him. So great exercise in saving faces for those guys. So that's the situation. Do I think then that is positive news for crypto and stocks? Well, typically, generally speaking, I do. I do think so. So do I remain bullish? Because that was the question a couple of weeks ago, and I do remain bullish. And that can bring us on to another topic conversation for today, which is live person. Do I remain bullish on live person? And I do. I remain bullish on it. What we had here was a big drop. Big old drop, came down towards these lows here, and you're thinking now maybe this is the double bottom. Maybe this is the double bottom. Maybe before, when we speculated about it, it was too slanted, it wasn't double bottomy enough. Maybe it needed to come down and make this test. So I was discussing this with people in the Discord. You know, if it did make a test here of something, what was it testing? Is a fair question. So if we look over to the left, we can see what was being tested, and there was this drop down that happened at the lows in April of 2024. A fairly steep, sharp, sudden drop, which created and left a gap, like at the time, and then was filled. People were asking me on my show, what's the 3-star buy price, what's the 5-star buy price? And I said the 5-star buy price was down here. But we couldn't make guarantees that we'd get there. It's just a case of expectations and probabilities, just like it is with the Fed. And we said, well, hey, it's not an expectation and it's not a probability, but it is a possibility and it's a real one, and it's worth remembering for your 5-star buy price. But whatever, we talked about the 3-star ones for about the last year, really. Because the 5-star ones just were not necessarily accessible. Well, we actually got one, but it was a sort of snooze you lose move down. So the low, this candle here is talking about in April, that's around about 53, 52 cents. The low of that candle is 51 cents. Go over to what happened here now. What was the low there? 51 cents. What does that mean? It means that this wick down was a retest of this area, which does put the question then, is this the double bottom that we were looking for? And I bring the drawings back onto the chart here, and let's be fair, you know, this double bottom that I had on charts, I was kind of suggesting it was, I did say at the time, you know, it didn't line up properly and wasn't perfect, but there's your idea, and that's the thesis. If we're not going to go back to that price again, right? If we weren't going back there, then that must have been it, although it's not perfect. And the lack of that perfection allowed it to be a real possibility that it could go there, but not a probability. I hope you're following along. The result being that we have had that now, so we now have got like a double bottom. This we drawn here is not so great, but I can make it a lot better by just going here, going blah, like that. There's your double bottom, right? Fan-dabby dozy. And we're looking and saying, is this enough? Is it enough, you know, or is it too much even? Was this drop down really a 50% discount from where the prices were just yesterday or the other day before? I can draw a Fibonacci retracement from the highs down to the lows to try and describe where we could go next. Then, as a result, I was doing this over in the live person page room. I was thinking, hey, what happens if this drop down and move up turns out to be one of the wee things I like to talk about, where you take your man at the highs, you draw him on the charts. Let me just do it real quick. You put him here, you make a diving board, you give him arms, you put a hat on him. You've seen this before in my show. He always wears a hat. Drawing this with a trackpad is difficult, but there you go, it's quite a big hat. He must be on holiday. And he does this diving board trick. Anyway, what we're looking for is to see, can he go back up again? And there's a certain pattern that it follows. It broke through the 236, that's pretty good. Risk management means you can be pretty positive so long as it's above 59 cents. Price is currently around 68 cents at the 382. And the question then is, since I always say that 382 is a natural retrace point during a trend, is this a move back up towards the highs, or is this a natural retrace during a trend? Is this a move up to the natural retrace point, or is this a V-shaped recovery? Where prices are at the 382 right now, they've not broken past it. We have to admit that this is the area where the greatest inflection can happen, right? Because we look back at the last time we had this discussion, and incidentally, we'd predicted this in advance. This little circle at the bottom here, where the prices wick down into, this circle here, was actually something I had on the charts before the wick happened. You know, funnily enough, said the prices will probably go here, wicked into it straight out. Anyway, I don't need to give myself accolades, but the point being here that this was a chance for it to do something similar. It moved up past the 236. Did it get above the 382? It couldn't quite. The 382 was at 102. You know, it got to highs of 101, didn't quite push past 102, didn't break the 382, didn't get the V-shaped recovery. And we've had a couple of these instances recently where it's not managed to break past the 382. Why? Because the 382 is a natural retrace area during a trend. And for the last couple of months, you know, we've had a downward trend, right? That's what it's been in for a couple of months. And the 382 is where the prices are right now. So, you know, these are my own textbook definitions. You know, is this a natural retrace during a downward trend? Well, yeah. And is it a downward trend? Well, yeah. But is it also a great setup for a V-shaped recovery here, from here? Yeah, it is. And then it makes it so it's less a question of is the 382 going to break, and it's more a question of have we got the appetite for the risk here, given it is high volatility and the percentage movements are real. Have we got the appetite for the risk here for this, or will it drop back down and retest 51? Somebody put it very well in the Discord. Who was it? Justin Pickerel, maybe. Sorry if I got if I remember exactly which person said it, but they described it and said it's like a situation where we need to retest this thing, and, you know, are you going to buy it again, kind of thing. It needed to be tested, needed to be answered, and the answer was given back as a yes, and it was a good test, and it was well done that person for describing it that way. Well, I agree more or less that that's what's happened, but we've also been unsuccessful at pushing above the 382. Breaking the 382 quite yet. I mean, that's actually maybe unfair. Like, we have begun. Like, sorry, I say just yet, but that was when I drew this drawing in. We have made it to the 50%. We're back down. So prices pushed to the 50 up there at 71, came back down to 386 at 66, and are still above the 386 just now. 382. I think that we're in the means, like, you know, in the process of a slow V-ish type shaped recovery that could happen over the span of a few days, and it gives a lot of time and opportunity for people to get in on it. The targets being a move up towards the 886. We might see a bounce off the 786 or something like that. Then you might see it catch itself and climb up the 886, bounce back down. You might see it catch itself, go up towards the $1 round number level, massive psychological barrier, and then if it breaks that, it might run, and it might run all the way up towards the 1618 at 154. 154 puts it above, you know, the prior highs at around 144, and it starts to change the picture over here, and it only becomes visible again on a larger time frame. So we'll just go back to this, make it clean. It starts to change the picture over here again, where you'd be pushing up past this prior high, having come in here and put in a low, which was not a close. So in terms of like daily closes, we didn't have a lower low here. But in terms of the lows, we got a push down. So we had the bigger picture double bottom, and the actual close on it was at the area of the previous double bottom. So bring the pictures back on. There's the previous double bottom, that's where the close was. This is where the actual low went to. So overall, I remain fairly positive about this, actually, so long as it's above 59 cents, and we could see this move up in the exact manner that I described just there, where they move towards 140 and 154 and break the prior high, and this here becomes a situation which is a classic kind of bottoming system. Is this just a shakeout to allow accumulation, or will it go lower? Because that's the story. I don't think it'll go lower overall, because the news is pretty positive. You've got positive earnings, you've got positive restructuring of the debt, you've got the fact that reality was faced. You know, they had debt, it needed to be worked with, but they got a way better deal than, you know, on paper they should have. So things are looking pretty good, and we just had an interest rate cut too, so there's stuff happening. There was one thing I wanted to chat about with people in terms of theoretical discussion here with regards to this wick, There's a wick being, by the way, if that's your candle, the wick being the bit that sticks down below that shows the range of the price in the day, but not where it closed at. And if this wick here had been a close and a body and pushed down into this region, you would have had to have answered one of two questions, right? Into this region here. Then you would have to answer one of two questions. One is, has the overall years-long downward trend continued and found new lows, and then will it push lower and so on because it got down, zigzags down, 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 right? Or is it broadening? Is it broadening out? Because then broadening has got its own kind of psychological set and its own technical set to understand. It's not broadening, especially when you consider the fact the close is so much higher than the wick. It's not broadening. So then, what is it doing? Well, is it just kind of having a end of bearish trend accumulation phase that involves shakeouts that go towards areas where there'd be big stop losses from people trying to, get in at the lows, but are shaken out by the volatility because of.
Think that a potential golden cross failure might be part of that mix, and what the recovery with the potential death cross failure might play in.
I'll have to get my indicator up for that. Jimmy's asking me in the background if I think there's a potential death cross failure could be part of that. I've not got it on there for some reason. I'll just add a double average, a moving average myself, real quick. Wonder why I moved that off. Maybe I didn't see it.
Still under 2.
Yeah, I just wanted to make it easy for all the new viewers to watch. I'll just do it with my toolkit instead. Cool. So set inside the box, by the way, are a 50 and 200 moving average on the toolkit. So what was the question? Do I think a failure could have been a part of that? No, I don't. Not really. No, I don't. I don't think that's a rational question. Whenever the prices that were being failed at were at $1. It's kind of like not deliberately not seeing the woods for the trees, because yes, there was a test and a golden cross here just happened and whatever else, but the golden cross happened while price was underneath both of the moving averages. In a fairly bizarre sort of situation. It happened, but then there was a gap down. Why? Because there was massive fundamental news, and it happened around about the $1 mark and so on, all this sort of stuff, which makes it so it's like, yeah, you're picking a pretty narrow path there to say this is why this happened, which involves ignoring really big, obvious, fundamental, massive things, which are the really pretty obvious reasons for why this happened. So I think that would be like technical analysis for the sake of technical analysis at the expense of all other sense of rationality. And I mean, that's not what technical analysis is for. So, but I do see why that might be a question. No, this was an attempt to change the story based on the previous price action, which was based on the previous trend, which is how things were going very well. Everything was going fine. There was the golden cross because things were going fine. And then we heard in the earnings call, like, the deflated tone that John Sabino had when he was doing it. Clearly, it's not his desire to do it in this way, in this manner, at this time, in this circumstances. But time's caught up with them, and the demands of other people have come in, and they've had the trump card and they've played it. And this is the result afterwards. So no, I don't particularly think so. I think it would be easier to say shakeout and paper hands, which is as equally dismissive and wrong as it would be to just simply say the failure of the 250 golden cross, given that cross happened and literally 2 days later there was the inevitable news that came along So, like when you're driving your car and you then have to pull over at the side of the road and whatever, and the engine light has been flashing the whole time, and there's smoke coming out of the engine in front of you, and then you pull over and somebody says to you, why did you pull over? Do you, maybe you've got a puncture or something? You can turn around and say, yeah, maybe I do have a puncture or something. But then there was also all this smoke coming out of the engine, and maybe that's the real reason. So anyway, yeah, there we have it. And but is this, does this mean it? Well, it totally does. The fact of the matter is that the company and the trend and the sentiment with the company was with all of the risk on board. So all the investors had understood that there was huge risks and had priced that in and were moving up. And then suddenly the change happened, and that priced in thing changed, and we're having to reprice in things, which is why you would think it's maybe cheap. That's why I was trying to say in the Discord as well, that ultimately all of these factors together give you a stock which somewhat looks cheap. Like, it looks cheap, it's a cheap investment. If you were a hedge fund shorting this, you have to deal with the fact that the stock price goes up and you don't close your shorts, you face infinite risk, because this thing could just go up and up and up. If you're long and you don't close your longs, you face risk of 68 cents right now, 68-cent risk, which obviously is determined by the size of your position and so on, but you've got 68 cents risk if you're bullish, you've got infinite risk if you're bearish. So it's not an amazing opportunity for bears, unless they thought they could kill the company, like in that thesis. If you know anything about GameStop and so on, and hedge funds killing companies so the stock price goes to zero and they don't have to close out their positions and all that crack, yeah, sure, cool, okay, could they do that with this company? Well, let's look at what the negative news was. The negative news is, if you just distill it down to one sentence, is we are no longer on a short runway. Our runway will last until 2029 at the minimum. So it doesn't matter. Now, if the stock price were to go to, say, something like 7 cents, and why I would pick a bizarre number like 7 cents isn't for just random arbitrary sake, it's because that is where the low was on the all-time low of the stock, having previously in time traded to at like $10, dropped down to 7 cents. Yeah, that's right, a 99.97% reduction, and then it went from 7 cents to $71. Yeah, from 7 cents to $71. You do the math. That's a big increase in percentages. Then we drop right down the way, and we're at the 50-cent level, from 70 cents down to 50-cent level again. And it's like, well, the short case on this one is pretty crap compared to when it was at $70, right? Pretty crap. And then if you then say, well, what is the actual real existential risk on this company? What is the jeopardy? Well, it's just gone down loads. It was way more likely to go bust 2 months ago than it is today. So what's the bearishness? Well, the bearishness is just sentiment, and the fact that technical analysis showed that there's a huge liquidity that would have hung out underneath that double bottom, the smaller double bottom, the first double bottom. The prices where price closed at, prices dropped down to there because that's where they were being sold down to. It triggered a bunch of stop losses and liquidations. Prices pushed down, immediately bounced back up, and then volume died. And it stayed at around about 68 cents for 2 days, having had 30 million shares traded the day before. I mean, that's not a company that's going bust. That's a company that had a certain amount of shares that were being traded, and then a flood of them onto the market because somebody had to hedge against the position, and then the sentiment, picking the 2 or 3 words from various headlines, such as preference shares for somebody else and debt restructuring, and think, oh gosh, this is probably bad, because it usually is. And what did we learn from the FOMC announcement of cutting interest rates today as the S&P moved down? People have been trained like Pavlov's dogs, and when the bell rings and they hear that they hear that there is a rate cut, they think, oh, there's a rate cut because of real reasons, even though it was already priced in and we already knew it was coming. The only way the markets would have responded really positively today would have been a 50 to 75 basis point cut. If it was a 75 basis point cut, the markets probably would have dumped even harder, right? Because they would have said, oh my God, not only is there bad news? But the bad news is bad enough that that bad. It's really bad. I don't even understand how bad it is. I don't even understand. But it wasn't that bad, and anyway, they dropped, and it was predicted, and it went down 25% basis points, and they think that there'd be a couple more this year. So the maybe we would have got a rise in the market had there been a 50 basis point cut, and Jerome had come out and said something like, yeah, we went with 50 basis points because there's so much conflict in the room, and we could all agree on it needing to be done and 50 points being acceptable. We got that across the line, but I'm not sure we're going to get any more cuts this year. So we went for that one cut, and I'm not sure we're going to get any more this year. This is what he kind of did last year, right? If last year had happened again, we might have seen a rise, but we saw a drop because it was 25 basis points, just enough to make people think, oh, what is it? Why is it bad? And it wasn't so much that it was enough that it actually deserves to go down. So then the prices came back up during the day, and they closed at like nowhere near where the wick was. A story that's incredibly similar to the live person one, except the live person one had the chatter and the news, and it had actual preference shares being given to some company that actually has hundreds of millions of dollars of skin in the game, who then has to then hedge against their own position because they've got due diligence and actual multi-million dollar company, $billion company due diligence protocols they have to do in order to satisfy their own shareholders. So there was a massive amount of volume, so there was a drop down, so it took out the stop losses that people had in a certain area, so they had to bounce off. Now, in cryptocurrency, I often look towards these wicks here and think, well, that's an expression of the tolerance of the market to drop down before before the depth of the books, whether it's intentional with orders anticipating it in place already, or whether it was just purely just the kind of the outcome at the time as people realizing prices are changing and choosing somewhere to jump in at and so on. The absorption happens, and in crypto you look at it and you say, well, hey, this is definitely now a real possibility. Before it had happened, it was a possibility it could go there. Now it has happened. It's a quite a high likelihood that will get at least tested again, and the crypto markets consistently test these wicks. Will it happen here in this case? It's very hard to tell, and the reason why is, and just to remind people, this was a part of the story so far. This is the weekly chart, but it makes no difference, right? The candle I was showing you before was in here on the daily chart, and I was saying the reason why is because it's tested this move down. It tested it, and then it bounced so far back up that the shorts, the bears, know there's hardly any meat left on the bone. Well, if there's hardly any meat left on the bone, where would they short it from again? Well, they short it below 57, 58 cents again. Why? Because it's probably a retest of 50, and if not, it's a retest of 44, and if not, then it's moving lower. So if not, it's a test 10% below, or another 10% below, or even further down. Those three things together, yeah, sure, that's something you could short, right? And that would be below 59 cents. We're not there right now. We're just not there right now. So there's no incentive to short, and there's also no incentive to try and, it doesn't make sense to be bearish on a stock so close to zero, which has got fundamentally more positive lifelong story. You wait for this thing to go bust, and it doesn't go bust for 9 years, and you're looking to try and make 69 cents per share. Come on, right? There's better investments out there on the negative side, and there are, right? But in terms of investments for the positive side, then suddenly this is one with a huge upside potential, which is why it looks cheap. And I put that in inverted commas every time I said it in the Discord post I was making as well about it. I put looks cheap in inverted commas because there's no such thing. Investors know and traders know there's no such thing as something that looks cheap. That's just a phrase that you use to describe how it says about it talks about sentiment and perception and psychology, and how the investor is perceiving the thing when you say it looks cheap. But it doesn't ever look cheap. It just is the price it is, right? You have to kind of separate out that emotion. So that's where we are with that, with the stories, right? So the stories of today, the main stories of today on today's show are FOMC guys. There are 19 of whom take part in it. 12 of them vote. And they voted today to reduce interest rates, but there's a big scatter plot about where the next cut could come from. Everybody agreed on the data today needing a cut, but there's a huge disagreement. Some people think interest rates need to go up. Some people think interest rates need to go down, but it's one of the most scattered dot plot charts in because what they do, by the way, if you didn't know, is they tell you what they've decided to do now based on past data, and they tell you what they think they're probably going to do in the future based on the data. And there's such a massive conflict. So all the people in the room can agree on one thing, but can disagree about everything else. It's like the blooming, it's like the Middle East peace process. You know, they're like, right, we need peace. Everyone gets in the room. Yeah, we all agree. We all need peace. How are we going to do it? Blah, a million different people disagree. So we needed a cut now, but how are we going to do it next month? A million people disagree, and that's the current situation with the Fed, right? We've had a rate cut. It's been good. The markets responded negatively to it because they've been Pavlovian trained into doing it. But really, from a technical point of view, you could have seen there was a bit of weakness a couple of days ago because there was a real kind of classic sort of candlestick candle on there that looked pretty bearish, and the markets are kind of due for a bit of a correction along the way. They're a little bit extended in this hyper on into September since a few weeks ago I told everybody that if Jerome Powell does a speech that is anything neutral to negative, there will be a relief rally, right? This bizarre situation that happened, and it did happen, right? Jerome Powell gets up on stage today and he says we're in an extremely unusual situation, and that's why it takes this type of long verbose explanation that looks at both sides of things and says this is what's really happening to understand it. And that's why it takes him like an hour of speaking on live TV with responding to questions and everything to actually explain things too. So it's real deal stuff. And yeah, that happened. So that was today's news. They cut it by 25%. By 0.25%. That's good. There will be more. One of the questions he was asked is this going to do anything? The answer is no. He straight up says it's not going to do anything. Why would he do that? Well, because that's a stupid question, right? It really is. It genuinely is. He's too polite to say it, but I can tell you, because I'm not so polite, it's a stupid question to ask because it's got nothing to do with what they cut today. It's all to do with the trajectory of the cuts. As you know yourself, from like a couple of years ago when the interest rates were going up, it was like, what did the one interest rate increase do? Not a lot. What did the most significant, fastest, strongest interest rates increases of all time over the period of a whole year do? Quite a lot. It's got a lot more to do with trajectory and the reasons behind it, and the data and so on. So anyway, what he wants to do is to show the trajectory. What do we see is in the terms of the market responding to it, is that there's a growth of nearly 30% in mortgage applications before the Fed even made their decision, right? After they made a decision, that's growing even more. Why? Not because interest rates, I mean, can you see the conflict? People will ask, well, how is a 0.25% cut going to make a difference, right? They'll ask that genuinely. And Jerome Powell genuinely doesn't say you're stupid to the guy, but he could. Because look at how the people are reacting before the rate cut came in to the 25 basis point cut. There were a 30% increase in mortgage applications. They don't care. It wasn't that if they paid 5% they couldn't afford the mortgage, but now it's 4.75 they can. Nah, that's not what they're thinking. They're looking at the trajectory and the path is what they're caring about. That's why they're applying for mortgages. So, since we all understand this already, and it is very much empirically proven that we all understand this already, that's the story. Right now, we know it. We are unable to articulate it to ourselves. Me and Jerome are articulating it to you. That's the chat, and it's. I think that really a correction to 6,500 on the S&P, no big deal. I'm bullish while it's above that, but that's still a drop, right? It could happen, and then with Bitcoin, I'm looking at it and thinking, yeah, this is positive. Could push up a lot, but it hasn't done so far. And if it drops below 114, could easily go to 104. That sort of exposure would have a negative effect on altcoins, which would be big. So there's a degree of sitting on your hands to see how things move. But I have a sense of trepidation about saying it's purely the Bitcoin chart moving, because the tail might wag the dog here. And I demonstrate that by looking at things like XRP, Cardano, Solana, the big ones, or a selection of ultra crap altcoins, S tier S coins, just to show you that there's something bubbling here, and it could be the altcoins that push the Bitcoin up higher. So there's a bit of a conflict, because Bitcoin here could pull back from these areas. Technically speaking, this is a key area to pull back from. What do we see here? This high, followed this high. It's a bit narrow in between. We take up this chart, we're looking, thinking, where's the momentum at right now? Is it flagging? Well, yeah, you can see it's flagging just in the candlesticks alone. And but that's a weekly chart, that's quite a lot. Here's the daily chart, and you can see that like things are going well, all that, right? You need this detail though, and then it's like, all right, now you can see actually that they're at a high. If this pulls back down, it goes down to 104. If it pushes up, 118's maybe a stopping, maybe a bit of resistance and so on, but you could expect it to go to 123, or push as high as 130, 128, 129, 130, actually 130, yeah, 130. So like, there's meat on the bone to take lower risk trades between these points, and this is at a point of inflection, so it's a bit risky, and things are at points of inflection where they're a little bit risky and they haven't shown you where they're going yet. Like, for example, live person. And this was the third major chat of the day, is that live person has done well. It could be in line to have a V-shaped recovery. I think it might, right? I do genuinely think it might have one, but we've been down this road before. Well, it's below the 382. I can't push that story to people. I have to remind them this is exactly what happened before. Didn't manage to really truly break the 382. So while it's here in spitting distance of it, can I push that agenda? I can't push that agenda. But I can say that, you start to see things creeping up the way. The story that I'm looking to see happen is exactly as I've drawn on the charts here. Move towards something like 87, pull back down to like 83, push towards 93, pull back down towards like 88, push up towards 98, 99, jump around here a wee bit, try 100, $1, pull back a bit, and then if we can bust it, we're going to 150. And we'll take out the previous high. We've got a range here which allows us to do so. We could take out the previous high, and then things will be moving up, which then leads to the next question. Well, if we had those lows and those highs, is everything broadening out? Because broadening out has its own risks. And you would say, well, possibly, because if I drew a line like this and I drew a line like this, and I said the next one's coming in at another high, that would be broadening out, and that would have its own sense of, its own technical set to look at. But that isn't the context, because really what we're looking at is whether or not this is actually the double bottom here of this huge, long, complex lower area. And therefore, if that volatility happening in that area, because we're living in the micro detail, because we live in the present, just like Jerome said, we're looking at the windshield, and we're looking at the windshield, and we're just seeing what's happening to us right now. We're asking questions like, what does this mean? What does it mean? But we zoom right back out and we say, there's this volatility here. Is it expected in this type of price range? Yeah, volatility like this is real here at this on stocks like this price range. And then if it dropped down and made a double bottom and had a big wick on it like that, does it constitute a shakeout? You only know it's a shakeout after prices have moved up. If we were sitting at $2 right now, we'd say that was a shakeout. We're in the middle of the post-shakeout trauma. And it looks like it could be, so long as prices stay above 59 cents, right? Super simple. If prices drop below 59 cents and like 30% of the entire world's live person shareholder base is literally listening to me right now saying it, then yeah, you could create yourself a situation, right? You could create yourself a situation. Imagine it. If you'd said before something like, if prices drop below 60 cents, that could be a problem. And then maybe literally like a massive percentage of the entire shareholder base for this small company might have put their stop losses at 59 cents. And then when you then zoom in to look at like, well, what happened whenever prices dropped down? It's like, holy smokes, they really got a lot of volatility there below that 59 cents back up to 70 cents area, or 69 cents to 70 cents, whatever. Was that all just as a result of a bunch of people putting stop losses in at previous double bottoms? It may well have been. So I'm not going to say below 59 cents, everything's different. On a simple technical basis, in an objective world where my own sort of agency doesn't influence anybody else, I would be saying that to myself. Saying it to everybody out there, I don't know. Like, I mean, I don't want to influence this thing. I'm just saying that's what the technicals are very, very clear about. If you're our expert, like I am, so that's what I'm telling you. As for whether or not it was to do with the moving average cross, I mean, look at this area, and you go, there was a death cross, golden cross here, a death cross here, a golden cross here, death cross here, golden cross here, death cross here. So we've had what, 1, 2, 3, 4, 5 major crosses since the prices put in their all-time lows. And it's like, I know you want to have that conversation about that. I understand. Except this is not on this time frame across this long a period of time, since over a year, about a year and a half spent within a range at the all-time, well, that's not the all-time lows, but it's, the all-time low happened in 2001 or 2007 or something like that at 7 cents. Like, it happened. This is the low of the last 20 something years. Okay, it's all here, and it's happening in a sideways. Price has gone sideways. I mean, you're not commenting on trend or changing trend. Where's the trend? Where's the trend been since April 2024 to September 2025? If in April 2024 the prices were 47, 48 cents, and in September 2025 the prices were 51 cents. What does the 6 golden and death crosses in between mean? So I have to put the context of any current question about the current golden cross that got failed or the current death cross that's happened up into the context of the fact that that's kind of meaningless right now when you've got those real fundamental changes and stuff. So I hope people are following along with me. This is a complex story, right? And I'm trying to make it accessible to everybody. I've explained a lot of this in the shows over time, and there will be more explanations of this to come. The exciting stuff that has to be known today is, 1, the Fed has changed interest rates. 2, there is a real actual enthusiasm about this because we've seen 30% rise in mortgage rates. There's a real impact the Fed has, real, on the economy. And it isn't to do with, this is the third point, it isn't anything to do with the actual size of the cut. It is far more to do with the sense of the trajectory. The problem generally is that there's uncertainty, even within the Fed and their chat about it, because there's a massive array on the dot plot of expectations about what will happen next. However, public sentiment is incredibly strong for rate cuts, and so much so they implied for mortgages. And that's the major problem for more rate cuts, because it's a case of managing expectations. Nevertheless, having said all that, I and the Fed are hinting to you that there will be probably 2 more cuts this year, and therefore cautiously we're optimistic about being able to manage a reduction in interest rates without getting into an inflation inducing situation while there are real fundamental, real strong problems in the economy, such as the labour market. So that's the story there with that one. And as a result, it's had a pullback on the S&P, NASDAQ, whatever. I don't think that that's necessarily there. That was already signalled before. It was pulled back up now and closed, or is trading in electronic hours and futures markets. That a pretty good recovery level. Nevertheless, if things move to 6,500 in S&P and others followed similar suits, I wouldn't be too concerned, because really nothing would have changed. It's still incredibly bullish and basically in spitting distance of all-time highs. So not that big a deal until it becomes one. Pretty positive. The live person story is not a million miles away from that, because we had a big drop down, a big wick, and move back up. Is it a threat? Yeah. Real possibility of problems, but will we see that happening? Not necessarily. Don't think this is a trend on this time frame. This is just sideways, has been for a year in a sense, and I'm looking to see it actually start to trend. We could get there if we get a V-shaped recovery with a move to the 1618, which is the target of 155 currently. So it's on. The actual close was not a lower low. The low of the day was indeed a lower low. So it depends on time frames, but really what you're looking at is that it's trapped inside the overall range at the lows and that there's huge volatility. While fundamental changes are happening, real shares are coming to the market, real hedging has happened, and real positive debt restructuring has happened, which could equal, at the end of it, shakeout, where weaker hands are left behind because they were scared of volatility before the larger move actually happened. That could be what's happening right now because all the pieces for it are there. To predict the future is a waste of time, and so I'm not going to predict the future and say that that's what's going to happen, but I will say that what I'm looking at is a circular piece of bread with tomato and cheese and bits on it, and I would like to call it a pizza, but it's not been put in the oven yet. And after it comes out of the oven, I will call it a pizza, as we all will, but it looks like and smells like a pizza to me. And then when it comes to the case for cryptocurrency, yeah, I'm excited about it. I think things are pretty good because the interest rate cuts should be positive for it, but will the tail have to wag the dog? I'm actually looking closer at how things perform to the upside with altcoins because they could drag Bitcoin up. And as ever, I'm being cautious and prudent with moves to the downside because Bitcoin could lead the way, as it usually does. So I've laid out the technical analysis for that. That's the story. I've repeated it a few times, so you've got a pretty good summary of where we are. Just taking a look here to see if I've missed any major stuff from people. I got Jim P giving me a beer a week ago, and that's it. Well, that's cool. Well, hey, good to know that yous were here. Love yous very much. What?
Go into win for the 10.
Oh, thanks, Go Win to Win for the tenner earlier on. Super appreciated. Cheers, buddy. And everybody, have a good night. I've been Rocky Outcrop. I'll be back again next week.